Just make a U-turn here.
I'm
You
making
don't have
a
to
U-turn.
follow the whole thing. Jesus.
We've never gone this way.
I deferred to you saying that way, but no, you always keep
right.
going past the Eagle's Nest. The Eagle's Nest is on the left, and you keep going.
Enough of the shenanigans, I tell you. Cameron's going to
And to think I really believed in you, Dave, for that one moment that you had the right sense of
I
where you were
thought he
going.
knew what he was talking about.
Well, that was your first mistake, believing
Right.
in anything I say. Hey folks, Dave Nadig, Financial Futurist here at VettaFi. If you can't tell already, this is a conversation with Cameron Dawson of Newedge and Barry Ritholtz of Ritholtz Wealth Management in the car on the way to Camp Kotok, talking about what data we believe, labor, inflation, recession, politics, you name it. We cover it in this 2-hour drive. I've cut it down to about 30 minutes. Hope you enjoy it. Cheers. Well, this is a great topic of conversation. We can talk about what data we believe, because clearly directions from Dave
We're going to data
should
now?
not be the data we believe.
Although there is something to be said that's worth examining about all of our routines and assumptions and never going back to first principles because it's just part of what you take for granted, and how frequently those beliefs are
Well, here, let me give
just
you...
proven false. The philosophical 30,000-foot view of what you're discussing is essentially the famous Professor George Box quote, all models are wrong, but some are useful.
Right.
Because, and people forget that,
I understand
whether
how
it's
we got
CPI
there.
or whatever.
No, I understand how we got there, and I'm not saying that the models were made to do a certain thing, but they now get used as a primary input in all sorts of other things.
Well, I mean, regardless of the models being right or wrong, don't they get us to a similar place, right? If the output is measuring wages or, okay, yes, the models might be overstating certain things, but we all saw the help wanted signs, and the inability to get labor. How much of that is also just a feedback loop of sentiment, right? There's a lot of that within inflation, which is that if you expect inflation to be high, then you are much more willing to accept higher prices. You just say, it is what it is. It's like the dog reading the newspaper, drinking the coffee in the middle of Hades,
Right.
going, this is fine. And a lot of companies that used to cover a company called Fastenal, they would talk about it. They'd say if people are reading about inflation in the news, they will accept higher prices. But if they aren't reading about inflation, but our costs are going up, let's say steel prices jump or something like that, we can't raise prices. So how much of it is just this tight labor market?
How does that work for labor? Because if I'm unemployed, presumably I'm not refusing to go get a job because I think I should not have to because the labor market's tight? Like, how does that work for the behavioral decision of an unemployed person?
Or an employer, or more importantly, the Federal Reserve trying to figure out when to stop raising rates.
It probably feeds into job openings. That would probably be the area where if you could measure the expectation for future labor.
Hoarding? You mean people just hiring extra people because they perceive labor to be tight?
Mm-hmm.
Okay, I can buy that.
That's around the edge. I don't think that was as big a deal as it was made. Keep in mind, a lot of what we know about, or what we believe about various economic elements. Let's talk about the labor shortage. There were a couple of factors driving the labor shortage, a lot of which I didn't see a whole lot of media coverage. So how many people were out on disability before COVID? Those numbers have been going through the roof. That's why the labor force participation numbers have been soft for so long for men, not as much for women. The number, you lost a couple of million people to COVID in the U.S. by whatever
Excess death,
measure.
Yeah, sure.
A big chunk of those were people in the labor market. Legal immigration,
Plummeted,
people want to blame Trump, but it's been falling for decades. Trump made it worse, and Biden hasn't reversed the Trump legal immigration policies. And so the population grows to 335 million from 295 million organically, and there are some natural parts of the population that just aren't working. The very young, the elderly, the people who are infirm. And this country has always thrived on ongoing immigration to take a lot of jobs that the average American doesn't want.
So are you in this camp that we can't have an actual painful recession while we've got near full employment? Because that's the phrase you hear from everybody.
It's tough to have first of all, you're always at record low unemployment right before the recession hits. Right?
Always.
Historically, when
Whatever
you look at
the
that.
opposite of the darkest before the dawn is.
Right. It's always the brightest before the night, right? To come up with
Except that metaphor is completely wrong, but other than that we'll go.
Right. Well, that is true, but
it's always brightest right before the eclipse comes and wipes out humanity.
Yes.
Yeah.
So the other aspect,
black
by the
holes.
way, of the labor pool that we don't talk about is what I have been referring to as Elvis has left the building. You take all these people who are in jobs that they don't like, in industries they don't care for, working for bosses they don't like, and you lock them at home for 2 years and you give them a shit ton of money, and a substantial proportion of those folks will get new skills, launch new businesses, create new apps, do something to say, you know what, I'm not going to be in retail anymore. I'm not going to be a waiter.
So the question is that being captured in the data that we look at in a measurable way? Now, obviously, it shows up in things like consumption and all
New
that.
business formation was at record highs. It's a good example.
But new business formation, the whole point I'm trying to make here is that based on the new business formation was largely the result of individuals getting tax IDs, not people forming businesses.
Some of them are doing grub
payroll.
hubs, but others are forming real businesses or taking a job different and higher paying than their old gig that they walked away from.
Or they're now in a job that requires them to be an independent contractor, which is
That's right.
incredibly
That's right.
common. And all of those
Right.
are new businesses.
Right, and that's why you were at record highs in new business formation in 20, 21, 22. It was straight off the charts.
But doesn't that imply that you're ascribing a level of health to the economy that's not there? Because absent
Who says the health isn't there?
I'm just saying, absent the gig economy, like go back 15 years ago.
Yeah.
If you'd said we just had business formation that looked like this,
Yeah.
with no new information, you'd be like, holy, the economy must be on
Very,
fire.
very different business.
But business formation
today.
always ticks up in a recession.
Yeah, that's right. People, the old joke
Usually
is
it's unemployed people who go start
right.
small
The old
business,
joke is I'm an
right?
independent contractor is code word for I lost my job.
I'm unemployed, yeah.
Right, but this was legitimately new. Unlike the last time, again, when you lock people at home and give them a ton of money and say find something to do to occupy your time, a lot of them found productive use for their time and money, and not just trading stocks on Robinhood.
There were so many benefits as well during the pandemic for small businesses. How much could have that spurred people? It would be interesting to know, did people start small businesses in order to get certain relief?
100%, I'm sure they did.
And employee tax credits, all these things. It was pretty significant.
Yeah, I don't disagree.
Yeah, so
The other aspect of some of the disruption is about people exiting the labor force at the very high end of the labor force, and the argument there is that it's less about people saying, you know what, I've had enough of this because of COVID, but that it was actually delayed retirements all through the post-Great Financial Crisis period where people didn't make enough to retire.
Went back to
so
work.
people who were 55 who probably could have retired in another economic regime ended up working the next 10 years anyway.
No, that argument doesn't really hold because asset markets were so strong. So usually retirement is being driven by the kind of your nest egg, less about what your current income is. But there were delayed retirements in the 2010s, so some of those just sort of fell into the COVID period.
And then we had
asset
early
prices
retirements in
helped. Yeah.
COVID. Yeah.
Well, you had early retirements, you had deaths, you had all sorts of, you had disability. David Kotok is a big student of what's going on with long COVID.
Yeah, I was about
and
to say,
some
have
of
you seen
the
any of the new data on
yeah,
that?
it's like 30 to 40 million people have suffered effects of long COVID, and it depends on how specifically you diagnose it. If you just want to talk about brain fog and some milder symptoms, the numbers are really high. But if you talk about people who have a debilitating illness that prevents them from going back to work Monday to Friday, 9 to 5, even if it's remote, it's still, depending on the study, 10, 12, 20 million people.
Jeez,
It's
okay.
a lot of people.
Yeah, so that's a meaningful single-digit percentage of the workforce.
Yeah.
But back to your point, Dave, or your question, which is, can you have a recession and a tight labor market? And there's two kinds of recessions. There's income-related recessions that typically are associated with a loosening of the labor force, and then debt-related recessions. So income statement versus balance sheet, effectively.
Right.
And you won't have an income-related recession if people's incomes remain resilient. People will spend if they have jobs. The old adage, is like with trucking. Truckers will spend money when they have money. As long as you're moving stuff around in the company or in the country, people will spend money. But it's balance sheet recessions that can happen where they can cause income-related recessions but have nothing to do with the labor force, right? So it's where people want to be able to hire, but they can't because they can't get access to capital because there's some kind of liquidity or solvency issue. So I think the question would be is that if you assume that you have a tight labor force going forward, are there balance sheet issues on the horizon?
And that's a really interesting question. What's fascinating is some of the hangover from the GFC, from people taking on too much debt, buying too much house, buying too many houses, is you have the sort of golden handcuffs of 61% of homeowners with a mortgage have mortgages that are 4% or less.
Right.
And they are sort of stuck where they are, because it's one thing if you go from a house that's 600 to 800, you're going to see a modest uptick in your mortgage. But when you go from 3.75 to 7.5, you double your interest rate. That's a much bigger increase in your monthly nut.
I saw somebody describe it as accidental royalty, that because we've raised the rates so much that we've now created this whole landed gentry.
Exactly.
People who can't ever get rid of their houses because their mortgages are 3%.
That'll change eventually.
Sign me up. I'm right there with it. It's like, I can't ever move. I have a 3% mortgage.
But that's the long tail of QE, right? If we think about unintended consequences of
really
a decade of quantitative easing, you suppress interest rates throughout the curve. That's what QE was so different than any other Fed policy. You put a hammer on interest rates in the long run. It allows both companies and consumers to term out their debt. And for consumers, I think mortgages are about 70% of consumer debt. So if you look at the effective rate of a mortgage right now in the US, it's only 3.6%. So the average mortgage, all taken together, is 3.6%.
Amazing.
If you get a new mortgage, it's 7.3%.
Which is insane.
So, and you see that average effective rate drift up, but these are long-term mortgages that it's going to take a long time for you to have the kind of balance sheet type of recession for the consumer like you had back in the Great Financial Crisis, because back then 35% of mortgages were floating rate. So when the Fed raises rates, people actually get priced out of their existing mortgage.
Right.
And that's how you get foreclosures. That's how housing prices growth went negative.
But the thing that I've only recently, like literally in the last few weeks, realized is that the United States is particularly unique in this. Almost
30-year
everywhere,
fixed.
the 30-year fixed is not a staple anywhere else in the developed world. And in Canada, they literally don't exist. Everybody's on a 5-year floater.
It's only because of Fannie and Freddie, but for that, you wouldn't have that.
But that's you think about the disconnect that's going to make between the Canadian and U.S. real estate markets, for instance.
Yeah, but the Canadian market has been going berserk in certain places like Vancouver for decades. It's 20
been
years.
So resilient to even these higher rates. You saw it was one of the reasons why the Bank of Canada actually started to raise rates again back a couple months ago, is that yes, CPI was falling, yes, PPI was falling, but housing prices started to creep back up, and they said, no, we can't have this, which just means that there's something else other than the cost of money that's keeping housing price appreciation so strong.
Some of it is a lack of supply, because following the financial crisis, we radically underbuilt single-family homes for the better part of a decade, and depending on whose study you want to pay attention to, National Association of Realtors, the builders, whatever, it's 2, 3, 4 million
but also
things.
in Canada, it's also concentrated in 6 major metros, and it's it's a much tinier market. So it's a little bit like saying, what if we had a major crisis for interest rates in real estate in New England, right? It's very pocketed.
So back to the golden handcuffs and people being locked, I'm curious what would have happened if, remember, the Fed stayed at emergency footing for a decade, way too long. In March 2021, CPI went through their 2% upside target then. They waited a full year to start raising. They're always late to the party, and June 2022, CPI peaked. And so they raised very rapidly 500 basis points. I wonder if they were a little less behind the curve and were doing
Doing
quarter
more
point
gradual.
increases starting in March or April or May of 2021 and gradually did this and didn't feel the need to overshoot, stopped at 4.5%. If inflation would actually be lower, because you wouldn't have the same tightness in the labor market, people locked in, too little supply, forcing would-be home buyers into apartments. Arguably, the Fed had very little to do with the end of inflation. It was primarily the supply chain unwinding, some other factors, the cure for high prices in commodities or high prices. They just, the lumber is too pricey. Hey, go cut down some
But
more
we haven't
trees.
seen that pull back at all. Like,
Well-
we haven't seen the reduction in pricing.
So
Well, we have. Lumber is back to pre-pandemic levels. A whole
some
bunch of
commodities,
commodities.
but if you go into any of the consumer companies, and Cameron, you and I were just talking about this in front of the 90, like the average like increase on prices from consumer company is much more than inflation.
Well, that's Sam
So,
Ryan's argument
Yeah.
of price
Price
over
over
volume.
volume.
So, to pile on this in like probably what is a very sacrilegious way, but I think we actually have to rethink how restrictive higher interest rates are to the economy when you have an economy that has termed out its debt, meaning that after 10 years plus of quantitative easing, higher interest rates are stimulative to people who are savers because
Right.
all of a sudden
Right.
you're getting paid for the cash that you weren't getting paid on
And you're
before.
consuming less.
And you could be consuming less, possibly, but you're just getting paid more. It's coming out of the ether.
Okay.
And Strategas put a note out this morning that talked about how the difference between the return that corporations are earning on their cash and what they're paying on interest rates has been near a record.
Right.
Meaning that because they've borrowed it 10, 30 years, they're earning more in their cash than they're actually paying out in
Right.
interest, which explains why you can remain so resilient with so many interest rate hikes.
Doesn't that imply that we're going to have like less capex than we should then? Because if they're sitting here saying, I have $1 billion cash balance, I'd rather collect on that than build a factory. You have to pile a lot of incentives to overcome 7%.
Yeah, and eventually it starts to bite because you do have to refinance your debt. But the point is that those refinancings happen at a slower pace simply because you have longer duration debt than you had probably at any other cycle. I mean, this is Warren Mosler's point, right? Like that we have the understanding of interest rates kind of on its head. Now, obviously, higher interest rates bite. Look what happened with SVB and First Republic earlier in the year.
Was that the actual rate or the rapidity of the rise that was so problematic for them? And there was some mismanagement in SVB. They had hedges on, decided to take them off, cash them in, and give everybody big bonuses. So they kind of killed themselves.
Yeah.
But there's been certain pockets where the higher cost of money or tighter liquidity certainly bit. Look what happened with IPOs and kind of the trickle down into growth equity and venture back in 22. So clearly there's a pain part of it, but the pain part of it has not, as of yet, outweighed the stimulative effect of people earning more money on their cash.
So, in other words, it's not that people are piling more money into fixed income or money market products. It's that they had that allocation, and now that allocation is throwing off more free cash flow.
Well, and also, I
Yeah.
think for more sophisticated bond investors, right? I mean, what's the duration of the ag done? Gone from like 5.7 to 8.3 or something in the last 15 years. I mean, the aggregate issuance is now much longer than it used to be, which means all these people who were just buying the ag accidentally increased their duration by 20 or 30%.
So in 21 and 22, we shortened our duration in our bond portfolios, not as a market timing trade, because we don't do that. But wait, why do I want to sit in a 10-year if it's paying me less than 3 years?
Right.
And so we made that, and
yet, despite everybody on the planet making that same math, we haven't been able to actually get the curve to.
So my investment committee meeting on Monday, our July-August investment committee meeting, was the first time where we said, okay, now's the time to push a little further out on the duration, because now you're yielding enough in a 7 to 10 year assortment of bond. Remember, we're doing this all through ETFs and mutual funds,
Right.
so that if you're getting 5.2 or 4.9 or whatever it is, hey, maybe there's more increase down the road, but I want to make sure I have a little bit of ballast in case in the possibility that markets roll over, or the possibility that there's a recession and the Fed cuts. And we didn't do it all at once. We did a chunk of it, and we'll look at it again in a couple of months, or if the curve ever uninverts, and do the rest of it.
Well,
but
you want to
in the meantime, your 3 years are paying you 5%.
Yeah.
Yeah, but you want, I mean, if the curve starts to bull steepen, meaning 2 years are falling, and that's how it's uninverting, you want to be long duration, right? That is the moment that you get out of credit and you get very, very much into long duration debt.
What's does anybody know the current duration of the average junk?
It's shortened because there's been less issuance.
That's what I thought.
Yeah,
Oh, that's interesting.
Yeah, and I mean, and that is, it's interesting. Just a couple days ago, we hit a new kind of yearly low in the spread of investment grade and high yield debt. And I think the big question that sits out there is how much of that is a function of people saying the economy's fine, there's no risk here, we don't need to price that in, versus it just being supply and demand, meaning corporations not wanting to issue new debt at higher prices, and investors saying, well, I still want 9% debt. So
that's the vibe I get from it completely, right? Because
really?
That's almost, because, I mean, just talking to the advisor community, there's this insatiable appetite for something slightly more interesting than the ag, right?
Yeah.
I
mean, look at the boom in private credit.
Yeah.
So I just had this conversation with a person who will be nameless, but very plugged into the hedge fund community. And we were talking about when equity markets were making their lows in 2022, that was pretty much, and a lot of hedge funds were getting, when their gates opened and they were getting capital calls back the other way, back to the allocators, those allocators were moving that money into private credit. Pretty much nailed the bottom in equities to sell and the top in private credit, although you won't see the top in private credit marked until the fourth quarter of this year, because it takes a full cycle for that to show up.
For everything to get marked.
Right. It doesn't get marked. It's not instant. So what looks like a crowded trade, we don't know how bad of a trade of it is. We know how poor the equity sell was already, but we don't know how bad the private credit purchase was. Hey, maybe it's okay. We haven't been reading a lot about defaults ticking up a little bit, but nothing substantial.
Nothing seems like a wall, right?
Yeah, I mean, that's where you just have to make sure that whoever you're working with has really, really good liquidity plans, because as long as they don't have forced sales, then you're fine. That's the whole point of it being private credit.
Right.
But if you run into some fund that has to actually sell the paper, it's bad news bears.
Do you recall the Blackstone issue last year with the redemptions?
Would be
right.
Yeah.
So a week before that blew up, I had the woman who was the head of B-REIT on before we knew anything about this.
Mm-hmm.
And we had kicked their tires in the firm to see if, hey, do we want to own any B-REIT? And in the due diligence process, you go through their gate, and their gate is very typical of illiquid, private, long-term holdings, which is, look, you're locking this up for 7 years. However, as an accommodation to orphans and widows, essentially, right? It doesn't say that verbatim, but that's essentially...
They crack the window once in a while.
Right, and it's 5% per quarter and no more than 2% in any given month. And so when that gate dropped, it wasn't because there was a problem with any product they had. It's because all these idiots said, I know I'm going to sell my B-REIT now before they have to mark it down.
It actually came from Japan. The
Oh, it's-
selling came from Japanese investors in BREIT, that it was actually very little that came from the U.S. that
Oh,
caused
really?
the gate to drop. Yeah. Now, that obviously caused U.S. investors to leave and exit the product, but, what's interesting, it didn't stem from
I did not know
domestic,
that. That's
yeah.
really interesting. But you can't sell because you want to sell. You have to apply to sell.
Mm-hmm.
It's not an as of right. And
But I think it's a really important point for investors, is that you're only as good as your company around you.
as your co-investors are.
Right?
Yeah.
And it's one of the things that we're very careful about when we're looking at alts funds. But at the same time, you think about liquidity, it's sort of like the give a mouse a cookie problem, is that if they never offered liquidity, then people would have not thought that they could get it. But as soon as you say it could be out there, you could access it as long as nobody else wants it, then you get into the issue where people think that there's some more systemic problem. So we see all these new evergreen funds popping up and the democratization of alts, and I think you have to tread carefully, because they're making liquidity promises that people will get disappointed as it's something that's new for them.
My assumption is if it's
assumed-
illiquid, it's illiquid.
That's exactly what I did. I mentally wrote it off.
So on real estate, we've seen office REITs pop by 50-60% in the last month or so. Obviously, being
How much?
Yeah, 50-60%.
It's huge.
That's
huge.
insane.
Yeah.
It seems insane.
So, is this another where office REITs were in another vibe session where it was just more fear and it wasn't the reality?
Put the 50% into context. How much had they fallen previously?
Yeah. Yeah, it
50%.
can smell pretty dead catty, but it's interesting that all of this is happening at the same time as you have meme stocks roaring. Look at Tupperware up 800% in the last month. IPOs are soaring. You've had new IPOs of companies calling themselves AI that make up foundation. So it's funny is how many times you try to kind of put the foot on speculative behavior. You can't.
People have given me pushback on tracking Ferraris and tracking Rolex, and my answer, and tracking
There's
luxury real estate.
They're great bubble indicators.
And it's like, hey, if you want to know where the economy's going, the top 10% may only be the top 10% of the population, but there's something like 40% of the discretionary consumer spending. It's some wildly off-kilter percentage, disproportionate percent. Maybe it was the top 5% was 40%. It was a wacky number. And that really gives you a pretty early read as to what's happening with consumer spending over the next year or two.
So this raises an interesting question, though, because we've seen asset prices start to recover much for the past year. If you look at the Federal Reserve, they have the consumer balance sheet, and what you can see is that asset prices, which include stocks, so consumer or household assets, have been recovering really since the beginning of the fourth quarter, obviously with the October low in equity markets, but also home prices stopped decelerating as much. They started re-accelerating.
Right.
So we've seen this recovery in asset prices. Is this the start of a new economic cycle? Meaning that you're going to see things like discretionary spending on Ferraris and Rolexes start to come back? Or is this just a relief rally of where we're still late cycle within the economy, and that it's likely that you're going to see more of a correction in overall consumer spending, mostly on those very discretionary items? It's almost as if to say, okay, obviously this is not a bear market rally because we've broken the bear downtrend, but do we...
Haven't made new highs yet in the NASDAQ, the S&P, or the Russell 2000.
So do we achieve escape velocity? Is this a market like 2019 where you had the correction 2018 and then rather quickly made new highs, and it was off to the races through 2019? Or
right.
is
Q4
this
2018 was the 20% pullback, right?
Yeah, or is this something that we're kind of stuck in a chop to the sideways as we kind of keep going through these short-term relief rallies and then stumble and come back up?
So I love the question. Are you referring to the market
It was a
cycle
very
or the
succinct
economic
question, I know.
cycle?
Both, right? Assuming that the market cycle leads the economic cycle to a certain extent.
So where do you date this economic